Hello, everyone, and welcome to this new episode of the Fundraising Insider podcast. And today, joined with an amazing entrepreneur turned investor who has a very unique take on investing. And this is something that you developed in a project that you will tell us more about later. But I think there's no one better than yourself to introduce yourself. So please introduce yourself. What's your name? What's your role? What's your background? Tell us all about it.
Okay, great. Thank you, Thibaut. It's always a pleasure speaking with you, and thank you for inviting me onto this program. You'll notice I have a lot of gray hair, and that means I think every one of those is kind of a different section in my life. Something happened. So as you get older, you kind of build up this whole portfolio of different things you do, and then people say, "Well, what do you do?" And I'm like, "Well, what did I do today? What did I do yesterday?" And it's different.
You start counting.
So I'll try to give you the story very quickly. I started off as an energy engineer. I wanted to save the world. Nobody else cared. So I ended up as a mechanical engineer working first in the defense industry. And then I left and moved to Japan. I was there for a while working at a steel company, looking at pollution reduction. And that was interesting. But after a while, I said, okay, now I want to move over to the business side of science and technology. Went back up my MBA and ended up at the end of that in startups. And wow, that was a whole lot of fun. After working at big companies like GM and Kobe Steel and Honeywell, to suddenly be working at a five-person company was, for me, that was great. I like wearing a lot of hats. I like doing a lot of different things. I like having, what I do that day actually make a difference to the success of the business. So having a real impact. So I loved that. And I ended up doing startups for 25 years and recently sold my last business and said, okay, now what? I don't play golf, so I can't retire. And I enjoy keeping myself busy doing a lot of different things. So I wrote a novel, and at the same time, like a lot of founders, I became an angel investor in other startups to try to give back to the community and kind of bring my expertise and some money to other founders that are just getting started. I've been doing it for 15 years. I've invested in something like 50 startups individually, and then another 100 through some group funds that I've been a part of. And hearing all the pitches, I would hear all the startups kind of like not really especially pre-seed, not really understanding what investors were looking for. So I had some extra time. I became a startup mentor and been doing a lot of that. I'm with like 8 different accelerators, especially ones in climate tech. I really enjoy. I like work with the founders. I like trying to help them on the right track. Sometimes I join as a fractional CMO. Some of those have been successful, some of them haven't. But out of that, I would see the same standings, the same questions, the same, what do we need to do to get investment? What do we need to do to get started? How do we hire people? How do we find funds? Should we hire a salesperson? All the same questions over and over again. So I started writing articles about it because I like writing. Doing that on a weekly basis. I put out an article. You can find those collected on my website, pitchingangels.com. It's all free. It's about 250 articles up there. So I became your typical angel investor. I'm on the executive committee of TCA, the largest angel group in Southern California. I am the vice president of Chemical Angels, which is a nationwide group that invests in chemistry and materials, but also as a mentor and a investor, I see a lot of startups that don't fit the venture model. If you're making new battery technology or you're making new Gen AI and this is going to be $1 billion opportunity or $100 billion opportunity, you need venture capital.
Perfect
That's
for
the way to
VC.
go. Perfect for VC and happy to invest in you if it kind of passes our filters. But maybe 90% of the startups I see, especially the ones in the accelerators, do not fit the venture model. They are not billion-dollar opportunities. They're not going to get to hundreds of millions of dollars in revenue, but they are really good products that have a real need, and I want to see those built. And so that led me and some friends who were kind of in the same situation to start working on our new initiative, which we call Unventure Capital, which is the opposite of venture capital, which is how do we fund the startups that don't fit the venture capital model? So I'm doing venture capital at the same time I'm doing unventure capital at the same time I'm doing writing. So every day is a bit of a mishmash.
You have something for, I wouldn't say an antinomic thesis, but you have something for this yin and yang. But you have unventure and venture capital.
Yes.
You
Yes.
have your book is called How to Kill a Unicorn. That you
Yes. Hey,
you
yeah, here's my
dedicated.
book.
There it is.
How to Kill a
And you
Unicorn.
dedicated
Yay.
25 years of your life to building unicorns, which is a bit of a
Well, none
teaser
of them got to
for the third
unicorns. They
segment.
were successful, but they weren't unicorns. But they
But
had some good exits.
say you were heading in this
Yes.
direction, so it's really funny.
Yes.
You try one thing and then you think, let me try to do the complete opposite. And
Yes.
I think it's a very interesting thing, a very just interesting point of view to have a good understanding of what you're doing. It's great to do what you're doing, but trying to do the opposite is also really nice. So I love the exploratory, very curious mind that led you to chase ventures like Unventure. I really like the name, honestly. Unventure Capital, which is going to be, I believe, the first big topic of today's discussion. So for our
Okay.
audience, hopefully by this time, getting used to the format, the podcast is usually split into three kind of parts, around 20 minutes each. So the first part is very typical podcast conversation. We start with a question, say a big topic, and then we go with the flow. We just discuss that. The topic of this first part will be your journey from a founder turning to investor, and then, as you briefly mentioned, but we're going to develop on that, moving away from the traditional model, yet sticking there because you're still part of the Chemical Angel Network, and it'll be really nice to hear what are eventually the bridges between Unventure and the angel networks, whether you receive some businesses in one and you say, well, actually, it's better you go to the other, and vice versa. You have
Yes.
those communicating phases. So that would be interesting to hear about. The part two is where you have to just trust the process. Is going to be a set of rapid fire questions. Yes or no, this or that. Very simple. The idea is just to get the gut feeling, the gut answer. And then we'll have a couple of minutes to discuss whether you want to change an answer, or if you hesitate between one or two, you can tell us more why you hesitated, for example. It's happened quite a few times where a couple of questions go well, and then suddenly there's one that
Hmm.
hits and they say both.
Right.
And so this is exactly the kind of fuel we want for the discussion aspect of that segment. And the last part, as we said, you wrote a book, How to Kill a Unicorn. And I thought, I'm so smart. I'm so creative. We're going to make a segment about how to build a unicorn because, antinomic again. And then we had the pre-recording call, and you said, well, that's literally the book that you're writing at the moment, if I may
Yes.
tease this a little bit. So I thought, oh, shoot, now I don't want to be spoiling this. So we are going to do an alternate universe with maybe another alternate story where we are going to do the narrative or the say that the resume or the intrigue of how to build a unicorn. What would this look like? Some of the key steps that maybe are often overlooked, usually when thinking about building a unicorn. So it will be very interesting to hear this. So, without further ado, by the way, I'm actually really mad at myself. I had planned, and I put it in bold on my notes, to start with Ohio gozaimasu, to give a little wink to your time in Japan, and I forgot. But this is how
Zanen
startups
desu
are.
ne.
So
That's
it is what it is. We adapt, we improvise, we overcome. This is the whole entrepreneurial spirit of this journey, this podcast. Let's jump into part one. Tell us more about the entrepreneurial journey. I believe makes sense. You have a technical background. You wanted to have an impact. You said it from the start as an electrical engineer, and then moved to another field, develop something, build it, grew it. You did it multiple times as well. What was the moment where, instead of doing the model, founding, scaling, exit, starting again, founding, scaling, exit, do it again, and suddenly you exited this loop? How come?
so I sold the last business mostly because it had scaled to as far as it was going to go, and it was time for somebody who's going to more focus on the operational aspects to take over. So we sold to private equity, and the company's still actually doing quite well. But I did want to do it again, but I wanted to do it in climate tech, which is my original passion. There's no point where I ever said I don't want to do it. It's that I'm not doing it full time at the moment. So the idea was I would become like a fractional CMO,
Gotcha.
and I would be a part-time co-founder. What I found was that doesn't work. Fractional CMO works because you're an employee, right? And you do what the CEO wants. And
Hmm.
that's great. But if you're used to being the CEO or you're used to being the co-founder, that doesn't work. I don't like being just an employee, especially when I
Right.
see an inexperienced founder who doesn't know what they're doing. And so my impulse is to say, well, that's what you're asking me to do, but here's what we really need to do. And I go into founder mode, and they don't want founder mode. So I've had that tension between being a co-founder and being an employee, and I found that that doesn't work. So I am looking for opportunities where I can join as a full-time co-founder. That actually leads into how we're structuring Unventure Capital. The idea that I could like be part-time CMO or part-time co-founder didn't work. If you co-founder are full-time,
Full time.
you have to believe in it. You are basically marrying your co-founder, and you need to dedicate the next 5 to 7 years of your life every waking moment thinking about nothing about that except that problems. Just haven't found that right one yet, but we'll see.
I know it's I use it a lot myself. The comparison between fundraising or building a
Yes.
company and a marriage. When you start a relationship, be it with a co-founder or an investor, when it comes to raising funding
Hmm.
or a partner for life, you first meet, then you date a little bit, you
Dating.
get to know each other,
Yes.
and then you get engaged, and then you get married. And it's the
Yes.
same for fundraising. You need to know your
Yes.
investor, what they want, they need to know you, etc. until they write the check. Here you said with a co-founder, it's a bit like marrying for 5 to 7 years. Relationships are getting shorter these days, but hopefully weddings last longer than 7 years.
Yes.
But why stopping necessarily at 5 to 7 years? This is really the number that caught me is that
Yeah.
you mentioned
Okay, so that's the venture
having
model.
a
That's the
co-founder,
venture
and
model.
immediately you put a
Yeah,
time ending to it. Is it because
yeah,
systematically your vision of building is exiting and you're refusing the idea of building beyond that? It feels like you find your passion and the fun in the 0 to 1, 1 to 10, maybe 10 to 100. And after that, when it becomes very operational and the business model has been found and it turns from startup scale up to just a business,
right.
you kind of lose that spark. Am I right in saying so?
All right. So the first startup I joined, I was there for 10 years until the company
Hmm.
was acquired. And then the second one that I founded myself, I was there for 13 years until that was acquired.
Hmm.
So it is not necessarily 5 to 7 years. However, 5 to 7 years is the venture model.
Yep.
And VC models set because they have a 10-year life to their fund that it takes them the first 3 years to do their investments. They have 7 years left
To
to
divest.
make money from it. They need a startup to be sold in 5 to 7 years. So from the day you get your check from a VC, they want the business to be acquired within that time frame. So anytime you're talking about a venture scale business, you're talking about a 5 to 7 year time frame. Now, the really, really, really big ones, the SpaceX's, the Open AIs of the world, they can go public, which means that they're worth tens of billions of dollars, hundreds of billions of dollars, actually
Hmm.
now trillions of dollars with SpaceX. So there are things you can do with the stock while it's still non-public, so that the early investors have a way of monetizing their investment. For
Hmm.
99% of the startups, it doesn't work that way. You need to get 90% need to get to an acquisition, actually probably higher than that. A few will go towards an IPO. So there may be ways of monetizing. That process is going to take
Right.
15 years or more. There may be ways of monetizing it again at that 10-year kind of situation. But for the most part, you need to go in thinking that you're going to need to scale to a point where somebody is going to acquire the business within about 5 to 7 years, and that really puts you on a fast time frame. That really puts you on a treadmill, and that's kind of the underlying force of venture capital. We're going to give you money. and you're going to grow, and they're going to give you more money, you're going to grow faster, and give you more money, you're going to grow faster, and then you're going to get to $100 million and somebody's going to acquire the business.
This
That's not,
systematically,
that's systematic. That's just how the venture world works. And
is
all of venture math is kind of based around that.
is there no point where an investor can exit by just hoping to have their shares acquired by another investor, say in 7 years? Well, they just get their shares acquired by another investor, and that's how they get out of this, and they get to cash out, even if it's not a merger or acquisition? Or is that just
You'll
extremely rare for
hear
that model to be
you'll
profitable?
hear people talking about secondaries where
Yeah,
a later investor will buy out an earlier investor. In the 150 investments I've done, I've never once seen a secondary.
okay.
So uh, I know they exist, but they are, I think you need to be at like Series B, Series C, where you have kind of the more private equity sort of way of thinking. So the idea,
Oh, for
at
sure.
least until you are in the tens to hundreds of millions of dollars in revenue, is we're
Mm-hmm.
putting money in, that's to grow the business, right?
Mm-hmm.
And if you need $10 million now to get to that next stage, we're going to give you $10 million, but that money has to go into growing the next stage. We're not putting in another $10 million to buy out the people who are there before you. At the same time, the early investors, I mean, if somebody came in and said, we will acquire your shares for 2x, that's great for the companies that are doing bad, right? We'll happily take that, but no one's
You're
going to buy out your shares for
limiting
the
the
companies that are doing
disaster.
bad. And the ones that are doing great, we're like, 2x? No, we're in it for 50x, right? So we're not going to sell our shares.
Okay.
So the economics really don't work out on either side of that, unless
Right.
it's kind of like an acquisition.
So we've mentioned the VC model, which by now is starting to get fairly familiar. And then there's unventure capital. So
Yes.
stirring completely away from this, what makes a project that is seemingly a VC-backable project, but there's something that tells you, actually, no, this is not a VC-backable project. It's not a bad project by any means, but this is where unventure comes in. Tell us about it.
Right. Okay. So start with the venture model. You're going to get to $100 million and get acquired
Mm-hmm.
for $1 billion. That's kind of the basics of it. You need to do that 5 to 7 years, but that's the basic idea. What if you have a great idea for a $20 million business, not venture backable, even $40 million business, not venture backable? First thing I look at when somebody sends me a pitch deck
Sorry,
is
you mean
yes,
20 to 40 million in revenues or just
in
valuation in
revenue,
general? In
revenue,
revenue, gotcha.
revenue. Yeah, because you're not going to get a high value acquisition. High value acquisitions come from strategic companies that are public companies, and they are not going to buy a business that's under $100 million in revenue because then it's not really a finished product yet from their point of view, and it's not worth their time. And it's going to take them $10 million just in legal fees to do an acquisition. So it's very rare to do an acquisition at a high multiple that gives you venture scale returns until you're at
Right,
$100 million in revenue. So that's always the number. You got to show a plan to get to
right,
$100 million in revenue, and then you're acquirable. So
gotcha.
I see a lot of great product ideas, and I look at it and I say, well, it's a $50 million market, and you're going to get you're going to be lucky to get a 25% share. So, it's a $10 million business. That doesn't mean it's a bad business. In fact, it can be a really great business. So, a good business that is built for profitability instead of for scaling should have 20%, 25% profit margins. Especially if you're in a protected niche, you're the only people doing it. It's probably not a big price point for your big customers if it's B2B. So you have some price, and you should be able to generate a nice profit. So imagine you have a $20 million business. Let's see, so 25% profit margin is, was that $5 million a year, right? So you're taking home
A bit more, yeah. Because
four
if it's
times
25
8 million,
million
8 million.
dollars,
Yeah,
yeah, something
yeah,
like
yeah. Sorry, I'm not doing my math right. It's early
that's
morning
all
here.
right. That's all right.
Anyway, yeah. So you're taking home 4 million, $5 million in profits a year, right? Nothing wrong with that. That is a great business. That is most businesses. I see a lot of those, and I look at, I look at the product idea, I look at the market size, I look at who the customers are. There's just not that many customers, or you can't charge them much for it, but it's a nice business. Nobody else is doing it. People need it. Make a profitable business. But the VCs are going to look at it and say, yeah, this is not a venture scale business. You're not going to get to $100 million. Google's not going to buy you out for, $2 billion. It's not a drug that, Pfizer's going to pay, $5 billion for. So it doesn't work for the venture model, but it does work for the small, medium business model, right? So our usual answer and has always been, okay, well, you have to bootstrap that, right? Use your own money, go get friends and family money, go get government grants, go get customers to prepay. And that's usually what I say. If you can build it yourself, build it yourself.
Build it
Find a
yourself.
way to, if you have to work nights and weekends, and, a couple of years not taking a salary, especially with software, you can often do that. Get to revenues, use the revenues to build your business, get customers to prepay for it, put it
Mhm.
on Kickstarter or Indiegogo, right, and get people to prepay for it, whatever. Get the money you need, get it built, get it out there, use your revenues to grow the business. So that's traditional, good old school business. We call it bootstrapping. If you can do that, do that. I don't care how big the opportunity is. If you can build it yourself, build it yourself. And don't go out and take money. If you're making new battery chemistry, you're making new drug, you're going to need $100 million, right? You're not going to bootstrap that yourself. So you're going to need venture
Mhm.
capital. So there's only one way to go. But if you can build it yourself, build it yourself. The problem is, I would see a lot that fall in this middle ground, this big middle between these are venture opportunities, we can get venture capital for it. These are much smaller opportunities, we can bootstrap it ourselves. What about all the things in the middle that are good, profitable businesses, but take $1 million that founders don't have to get it off the ground? And that's where we come in with unventures and saying, how do we build or how do we help build those $10 million businesses, those $20 million businesses? Essentially, what we're doing is we're coming in as a co-founder. We are going to be part of the team. So it's not just writing a check. If you just write a check, it doesn't work because it's complicated. But basically, venture model works where you just write a check because everyone's incentives are aligned to getting to a big exit as quickly as you can. If the goal is profitability, where profitability is a little bit left over after all the expenses and after all the salaries, then the people inside and the outside investors' incentives are not aligned. And you can do it as a loan where you're forced to pay it back right away, but then loans have, you can't charge more than like 10% on a loan. So you're not going to get a good
So
return.
you say you come in as
So,
a co-founder, but
yeah, yes,
are you coming in as a co-founder and taking equity in exchange for that? Or is it other
yes.
models like taking, I don't know, a share of royalties on the revenue that they're making, and then you're building your
That's a
entire
really good
revenue
question.
from this? Like what's the,
Yes,
in a way, the business model or the revenue model of a
yes,
VC is very easy. You're making money
yes.
by
Off
you're
the
putting
exit.
money in and you try to get
Yes,
money out. Here
yes,
you're not are you putting any money in? What
yes.
format does it come in? What do you get in exchange? And
Right.
how do you get the money out? What format does it come in?
Yeah. So the answer is, and it's a really good question. So we are coming in as co-found, like your rich co-founder, right? We're going to be the co-founder that provides operational assistance, but also brings in the money you need. Maybe, it's not going to be a huge amount. It's not going to be $10 million, but maybe let's say $1 million,
Mhm.
right? That you need to get off the ground. The form we do it is going to depend on the business and how quickly it can get to cash flow positive. It's going to be a mixture. It's going to be some amount of equity. It's probably going to be some amount of loans. It's probably going to be some amount of, as you call it, royalty. But the idea is that we need to get our initial principal back as quickly as we can so we can invest it in other companies at the
And
same
grow.
time. But in terms of getting a return from it, that's going to be, and it's going to be salaries, right? Because we're going to be working in the company and bonuses for the team members that are there. So we want to share in the upside with the founders. So it will be a combination of kind of all of those. So if you watch Shark Tank, this is kind of the interesting thing, right? Everybody thinks Shark Tank is venture capital. And other than Mark Cuban, it's not, right? Mark Cuban does, like here's my $2 million for 5% of the business. All
Hmm.
the other guys and gals are
Talk about royalty a lot of the
they're
time.
talking about royalties. They're talking, and actually, they don't talk about so much on the show, but if you look at it afterwards, they're doing all of these introductions. They're putting you into their marketing channels. They're introducing you to customers. They're getting you into the stores. Well, they're charging you for that. They have marketing teams that are basically going to do that for you, and you're going to pay them for it. So we're going to be co-founders, but we're also going to be salaried employees. And then part of it depends on the tax situation, right? It'd be simpler if we could just do everything as equity, but then we get taxed
Hmm.
on the returns. So some of it is probably going to be loans. So it'll be a mixture, and it'll depend on the company, and it'll depend on how much we have to put in, and whether we're working full time or part time, and what sort of is this a $25 million business? Is this a $5 million business? Is it going to take 6 months to get to profitability? Is it going to take 2 years to profitability? So we need to factor in all those details to come up with um, a plan, but it's going to be different, I think, for each of the startups. So
Right.
there's a lot of different knobs we can.
So is the only feature or the only KPI, if you want to call it, that determines whether a company is a fit for unventure or venture capital
Mhm.
is the projection of revenue.
That's the first cut, right? So if it's $100 million and beyond business, that's venture capital. Anything below that, the venture capitalists won't talk to. So then it is potentially a
Hmm.
fit for unventures. But for unventures, it also needs to be something that can get to profitability pretty quickly with a limited amount of capital. Because with venture capital, the assumption is it's power law that 10% of the investments will give you 99% of your returns, right? So it's buying
The
lottery
inverse of
tickets.
the insurance model.
We're going to invest in 10 companies, and one of them is going to be successful, but it's going to be so ridiculously successful that it makes up for our 9
Covers
losses.
the
It's
rest.
lottery tickets. With unventures, we need to turn it on its head and say, well, we need 90% of these to be successful, or else we can't make money off the profits. That's why the VCs don't do it, because the profit stream is not humongous like a big exit is.
Hmm.
So we need 90% to be successful. So we need to look at the business plan and say, is this a 10% chance of getting to profitability, or is this a 99% chance of getting, of being successful? So, and then, what is the profitability? Is it 5% profitability? Is it 50% profitability? How much revenue does that take? And then for us, again, we're going to be joining as co-founders. That means kind of all of the things that go along with co-founder kind of fit in there, right? We can only join a very small number, so it's not like the VCs, which can invest in 50 companies at a time. We can invest in 4 companies because there's 4 of us that are going to join 4 companies. We don't have LPs that are giving us $100 million to play with. It's our own money. So we don't have $100 million. So it needs to be with a relatively small amount of capital and our time and expertise, whether that can get to profitability and start getting us a return. But that means it needs to be in a field where we have some personal expertise, or else we're not a good co-founder. So there needs to be some value add that we are bringing to it. So I see some that are like, well, that's great, but it's AI, and we're not AI people, so we're the wrong people for it, even though I think it's a fit for our model. And then we need to get along with the founder, right? Because we're going to be a co-founder. So it's a lot more intensive process of kind of picking a very small number of companies to work with.
What is the scalability of a model like this? Because it feels like
Yeah.
um, we're talking about, oh, not all, only a small fraction of companies out there
Yes.
are actually VC backable, and
Yes.
a major part, it might be the majority, I don't know from your experience, you'll tell us, of those companies are not actually VC backable. And
Yes.
venture sounds like the solution, but given the fact that you need basically one person per company, the portfolio that you can actually
Yes.
welcome in this model is very
It's
limited. So
tiny. Yes.
are you doing venture as a solution to the problem that not all ventures are VC backable? And if yes, how do you deal or cope with the fact that it's a model that's not necessarily very scalable, and it can't fix it all unless everyone who has
Yes.
experience in the industry starts to do this model. But the amount
Yes.
of HR to company compared to the VC model where you
Yeah.
say you can have a couple of people, they invest in 50 of them, and that's fine. How do you deal with that?
Well,
Is that something that
we're
haunts
not
you?
going to
Do
say,
you wish
unfortunately.
you can make it bigger?
Yeah. So unfortunately, we're not going to save the world, but hopefully we will help a handful of companies. The idea longer term, kind of our vision is number one, once we prove the model, we can bring in some LPs that would allow us to expand. We can bring in more. So we're fortunate. We're all exited co-founders, exited founders. So we have personal resources. So we have both the expertise to join as a co-founder and the capital to be able to
Right.
do it. We know people who are like retired executives, like, well, that's a great idea. I've got some money, but I don't want to be a full-time founder, or they haven't done startups before. They've been, so they could
Let
put
me
in money. On the other hand, we know like other founders who are like, this is a great idea, but I don't have $1 million to invest, so I'll be an operator. So the idea is kind of longer term that we could not just be both the funder and the operator, but be able to match those together in and have a wider variety of expertises and access to more capital. So that's one thing. The second is, if we prove this model, I would love to see like 1,000 other people copying this, the same way venture capital has kind of exploded. I would love, this is not exclusive to ourselves. If anybody thinks it's a great idea, I would love to
do
see you
it.
go off and do it yourself.
Is you say that you'd like to become the matchmaker for those, for the people who can put in the money and the people who can execute. Is another model, which is you become the actual, so you have some of the people that originally were here who had the money, and so they do the money and the operational. But if you bring LPs along the line, then you can hire, I guess they become partners. Could they become partners?
Yes.
Where you just bring more people internally, and
Yes.
so people entrust you with money to do this, and suddenly you become kind of a venture builder that also provides the co-founder. It makes me think in a way a little bit like the Marble sort of model, although that's still a studio, a bit different. But is that a way that you would think about growing as well, where if you have more LPs and more capitals coming in, then suddenly it also opens the door to someone who would be a perfect co-founder type profile, but that does it through you.
Yes.
Do you see the
Yes,
difference between
absolutely. I think
matchmaking versus
you're
hiring
describing
it?
better. You're doing a better job describing what I was thinking than I did myself. So yeah, I guess maybe it looks more like a venture studio, right? Where you have
Right. Okay.
investors and you have operators, except instead of it being a venture studio where the goal is to build venture scale businesses, it'll be an unventure studio where the goal is to build profitable
On
businesses,
venture
and we're
businesses.
helping bring in the entrepreneurs
Gotcha.
to run it. At the same time, we're bringing in capital. Right now, those are combined together with us, but it doesn't need to be that way.
When those companies come in, you say that, well, seemingly the business is limited in terms of the market that it can reach. Let's take a 50 million as a cap, because
Mm-hmm.
anything below 50 million is we'll call it here non-venture backable. I'm sure that in
Yep.
certain industries it's still venture backable or whatever. Is one other thing that you're looking into also, first verifying this assumption, because maybe you're finding out that, wait a minute, they think they're not venture backable, but if we play our cards right, we can turn that into a venture backable business, and you turn their 50 million business into 150 million, and suddenly you can also get VC funding behind this, and that's the way that you could exit. Or option two, those businesses sound like the perfect business for a roll-up. So a smaller scale acquisition that then feeds into a bigger one, to give it, I don't know, a specific technology that will enable a big company to grow even bigger or something like this. Is this what you have in mind, or what's behind your original signing? Because there is what you could do with the business as it is today, but if you bring more to it beyond the execution that is promised of, say, 20 to 50 million, you could have something else in mind, like, oh, actually, we could grow this company to 20 million and then have it roll up by another business. And that's a way of getting an exit that is not the VC type of exit, but that's an exit as well. And it still works. Are those other models that you've got in mind that you are actively pushing in this direction? Or you're only thinking of the flat, say, revenue sharing or something model?
So, I mean, every business has a lifetime, right? So you do need to think about the
Right.
exit. We're just the venture model says there's going to be a big exit to a strategic acquirer that's going to pay like 10x revenue. And if you
Right.
exit, if you get to profitability, then a private equity will buy you. But they don't pay 10x revenues, they pay 4x EBITDA, right? So
Mm-hmm.
basically, you could keep the company for 4 years and you would have gotten the same amount of returns, or you can sell it now and have gotten 4 years worth of your profits all at one time, and you can put it in something else. So there's always, if you get to profitability, there's always the opportunity for the exit, and then it's like, okay, well, it's up to the founders. They want to keep going and getting more profits, or they want to say, okay, it's time to turn it over to somebody else and take our cards off the table. So that's always an option. Now, the nice thing about unventures or bootstrapping is you always have optionality, right? You can always say, I thought this was a $20 million business, but I've just added some new feature that opens up a whole new market that we hadn't thought about
And now it's
before,
80
and
million.
customers are buying it, and now it's $1 billion market. I go out and get venture capital then. It doesn't go the other way. Once you get venture capital, you are on the venture path. You are shooting towards the moon, and you better get there or you're crashing.
Mm-hmm.
But if you're building it for profitability, you always have the choice, and this is up to the co-founders. Do we keep going for profitability? Do we invest ourselves in trying to expand other markets, or do we take outside
Mm-hmm.
capital? Do we take loans? What is our path forward? And that option is always available and something that should always be discussed. So absolutely, yeah. If we see something, we're in there. But the goal at first is to bootstrap the business to being cash flow positive, right? Without taking any other outside capital. Once we've done that, then it's always a choice of how much money
Then
do
you have
we
the
want to take off the
flexibility.
table versus how much do we want to invest in growth versus do we take loans or do we invest ourselves? Do we take venture capital to get to another market, or do we not? So yeah, that's always an option, and it's always it's part of the plan of that's something we want to be thinking about.
Let's think about the competitor slide to go in the pitch deck
Hmm. Yes.
thesis, which is what we love to talk about. If we were checking the incumbent to unventure capital, as we said right now, unfortunately, your bandwidth is limited. So
Yes.
say I'm a business that is exactly in this position. I'm not really VC-backable, but I believe that I can get to profitability fairly quickly, get to 20 million. I call you, hi DC, I've got this thing going. I think it could fit. You tell me, well, look, we've got our hands already full,
Yes.
and you're going to find another solution. What are the other solutions out there at the moment, apart from Unventure? What are the incumbent solutions to a business like this if it isn't going for VC? You mentioned grants. Anything else?
So, I mean, it's what everyone is doing right now, which is you have to choose between venture and bootstrapping. And that's really your only choices. And there's not a lot of options in there. And
Uh-huh.
so, what usually happens is the ones that can bootstrap the ones that can't. I hate this, but when they're not, when you know, the VCs say, look, we're not investing in $20 million businesses. They go back and they redo their tam tam sum and they do their business plan. And magically, the next day, their business
Boom, 100.
plan or their pitch deck shows them getting to $200 million in revenue. And I see that over and over and over again. It's like, well, this market that we're after is too small now, but hey, there's this other opportunity here that we can go after. So, and that's a much bigger opportunity. So let's put that in our pitch deck. And I see a lot of that in those companies. A lot of them don't get funded, and the ones that do usually crash and burn pretty quickly because this is their market, not this, and this doesn't work. But
Who is to
the ones that
blame?
can, bootstrap, right? And so bootstrapping,
Right.
again, friends and family money, customer prepayment, right? Consulting with the customer. You can basically get the customer to pay for you to build the product by having them hire you as a consultant. You
Sure.
do all the work. And while you're doing the work, you're automating the work, right? And then when you're done the project, you now have your product.
You're fixing the
And you,
problem with the
yeah,
feedback as well. It's a great model.
and they're telling you exactly
You're
what they
like
want.
an
They're
RPO.
giving they're giving you a statement of work that tells you exactly what they need. then you give it to them and they say, well, we like this, we don't like this, fix this and fix this. And when you're done, you have a product and you go off and sell it to everybody else. So consulting, non-recurring engineering, joint ventures with customers or joint development effort with
Hmm.
customers, you can use their resources, you can use their labs. They're giving you feedback the whole time. Indiegogo, Kickstarter, things like that. Government grants, the SBIR program should be back any day now. That's like $1.5 million, and you can stack them so you can have like 5 SBIR grants and have $7.5 million of funding.
Right.
You're doing hard tech. Oh, there's a lot of ways to build the business without getting venture funding, but it does mean being scrappy. It does mean a little bit of this, a little bit of this, and a little bit of this. And VC is tempting, right? Just write a pitch deck. Somebody writes a check for $2 million. Like,
It sounds easy. It
uh,
sounds like the easy
yeah,
option.
that's it seems easy. The problem is
Seems being icky.
you're now on their path, which you shouldn't be.
So you said, well, there are some cheeky options where sometimes it goes 20 million and then suddenly the
Yeah.
next day it's 100 million.
Yes.
Who's actually to blame here? If anyone, you're thinking don't hate the player, hate the game. This sounds a bit like it because you're saying, oh,
Yes.
this is a cheeky move to go from 20 to 100. But in a way, if that's the only way that they get that they can get the VC funding, and the VC falls into
Yes.
it, falls into the trap, I want to say
Yeah.
it's not. It sounds like a you problem. If I was a founder and the VC tells me, but you lied to me and you said it was 20 and now you say it's 100, but it
Yeah.
wasn't. Well,
But they're
you're the
not
one
lying. They're
forcing me.
saying yeah.
Founders are kind of forced to find in the current model, in the current world.
Yes.
It feels like when you're starting a project, you are forced to make sure that whatever you're doing, the numbers equal 100 million.
Yes. That's right.
And then it's all about whether you can actually back that or not. Is it
Yes.
always a bad thing to do so because it's like cheating the game because you're just giving what they want to hear? Or do you think in some cases it's a good thing to push to this because it forces businesses that had a hidden potential to actually do the work to uncover that potential and maybe actually reach that 100 million potential? Or is it just so rare that it happens that it's not really worth going through it?
So if the founder doesn't really believe that there's $100 million opportunity, then and if they're saying, well, there's some tiny chance I could get there, so I'm just going to spin it and tell them it is, then they're lying, and that's bad. But that's not most cases. Most cases is, hey, I got this great idea, I got a product, I know there's some niche over here that they're willing to pay us right now, but that's a tiny part of the market. There's all these other things we could do with it.
And we
How
could
big
go over
that
here.
is, nobody knows. When you start a business, do you really know that this is a
No,
$50 million business? You don't know.
not at all.
Do you know what kind of competition you're going to have in 5 years? You don't know. So you're making a guess at it. Now, if you are doing battery chemistries, I use that as an example because I work with a lot of battery startups. If you're doing battery chemistries, you do know, right? Because you know how big the market is for batteries, and so you can take over some percentage of that. You have a good idea. If you are doing AI for car dealers, how big is that? I don't know. Could be 5 million, could be 500 million, right? It's don't know. So what you do then, of course, is you put together some estimate that shows you're going to get to 100 million. You work the problem backwards. I don't like that. I like it. I prefer you start from the beginning and
Bottom up.
say, okay, here's who I'm going after. Here's their needs. Here's how much they're going to pay. Here's how many of them I think I can get. Here's my plan for how I can market to them and get that percentage. And that gets me to this size of market opportunity. Cool, that's $200 million. That's my plan. Or no, that's 25 million. That's not going to fly. I'm either going to have to build it myself or I'm going to have to find a different market. Like, okay, not car dealers. How about airlines? All right, they'll pay more. Fewer of them. I work the problem forward again. So if they're working the problem forward and they're saying, I think I can get to that 100 million, and here's my plan for doing it. That's legit. When they go the
Okay.
other way and say, I need to show how I'm going to get to 100 million, so I'm going to make up some numbers that is going to try to convince somebody to give me money, I'm less happy about that.
So as long as you use this 100 million not as an argument to build a narrative, but more as an objective to actually
Yes.
de-risk your path through it, bottom up. So you start with a top-down vision, but your plan is actually to reach it bottom up. So you actually have to make both match. If you manage to make both match,
Yes.
and you have the
Yes.
arguments to back it, you do the de-risking, then good. Okay,
Yes.
very interesting. We said this was going to last 20 minutes. It's been 15 minutes,
Yeah.
but it's been fascinating. It's been fascinating because it's the kind of stuff that no one really talks about,
Nobody
and
talks about this. Yes.
it's rare to hear something that could sound like a failure when you hear, no, we will not fund your project. It sounds like a failure because the objective was to get VC funding. You go to get VC funding, you don't
Yes.
get it. Failure.
Right.
But it's not.
That's not a failure.
I'm glad we could talk about this.
No.
And yeah, it would be great if it develops more.
Basically, the VCs have saved you from failure. The failure is when you tell them it's $100 million and they give you money and
Yeah.
you find out it's $10 million business, but you're spending $20 million a year to build it and then you fail. So that's the failure. The failure is not when you go to the VCs and you say, give me money, and they're like, that's too small. And you say, you're right. Let me find a different way of building it. Let me find a better way of building it. Let me find a model, a way to finance it that fits what my business is.
Thinking evolution, the Unventure model was born from what the VC model could not do. From my personal research and just, intuition and also observing what's happening out there, the VC model as it stands today fits certain things, but
Yes.
people starting their own businesses, and we are lucky to have all of the tools today that everyone can build a business. This means the number of businesses that are not backable is also increasing. The VC-backable businesses are increasing a lot, but the non-VC backable are also increasing because there's more of those, it's exploding. So is this access to innovation, the explosion of venture creation, not necessarily VC backable, a driver for an actual systemic change of the VC model? And do you think that VCs are actually going to evolve into something more aware of the success rate, and instead of chasing the 1 out of 10 or the 1 out of 20, they're going to transform and try to bring on board more operating partners, more portfolio support, so that they actually can allow to have 200 million exits or 100 million or 500 million exits instead of the 1 billion, because they're aiming to have a higher percentage of exits by bringing more additionality. And in this way, the Unventure is meeting the VC, and there's going to be some kind of spectrum of everything in between. And each of them the Unventure will tackle the 10 to 20 million, something in between will tackle the 50 million, and then the VCs will stay at the 100 million. Do you think that this kind of evolution of, it sounds like there's, the back in the days, there were stuff in the sea and living stuff on land, and then amphibians are starting to appear. Do you think amphibians will appear, and is this going to be the new meta in the world?
So you have outlined a really exciting future. I hate to say it, but I think the answer is no.
Really?
I think the
Okay.
VC model is easy. If you have access to capital, you can hire a handful of people, you can invest in 50 companies, and if you're lucky or you have the right connections, then a few of them hit big and you make a lot of money. And that's really the venture model. The unventures model can't invest in a lot of companies, requires it requires a lot of time and a lot of work by people who have expertise. And that's just the number of people who can do that is pretty small. So I would love to see 1,000 unventures out there, but 1,000 unventures equals like 25 VCs, right? And we know there's like 10,000 VCs. So I think this will always be a niche. What I would like to see is unventures be put out of business by more bootstrapping capability, right?
Right.
More people thinking I can build that 10 million, $20 million business, and I have personal resources to do it. I have family resources to do it. I have government resources to do it. I have customer resources to do it. So that would ideally be what I'd like to see, is more easier bootstrapping.
But what
But
about
the problem is
the
if that
hybrid
happens,
model?
then everyone's going to bootstrap, and it's like, oh yeah, free money, I'll build my own company, and then they'll all fail, right? So there's a limited number of companies that will be successful.
What about this hybrid where it's not as demanding as the Unventure model, but still a bit more than VC, something in between where you can still have a wider portfolio, but the input is on the exactly co-founder level, and you manage to streamline the support that you bring in or automate it, or just create systems that allow you to have a 10-person team, but actually get like 20 or 30 maybe investments, or something you see a little bit in between. Is that just an unviable middle ground, you think?
So I think it could be, but within particular specialties, right? So one of our
Oh, so yeah,
challenges
absolutely.
is,
Boutique
so
VC
imagine
being
imagine
like that. Yeah.
SaaS software, right? So you
Yep.
could have 10 founders all building different SaaS solutions, right? One of them is doing, SaaS for bowling alleys, and one's doing SaaS for liquor stores, and one's doing SaaS
Mm-hmm.
for something else. There's a lot of overlap between them. The tech stack's going to be the same, the shipping challenges are going to be the same, the capital challenges are going to be the same, the accounting, CFO sort of roles are going to be the same. So in that case, I think it's easy to see like a venture studio where you have 10 or 20 of them where one or two people can be kind of recycling a lot of the same assistants across all of them. And I think that's very possible. Most of what we're looking at, and maybe this is just personal interest, is hard tech, meaning we're actually manufacturing things and each one of them is going to be very unique.
Mm-hmm.
So a little bit of that, some of that expertise will go between them, but a lot of it is going to be different. So again, if you stick within a particular vertical, again, so SaaS, but
Yep.
maybe like pharmaceuticals. Now, pharmaceuticals takes a lot of money, but let's say we're pharmaceutical systems, right? Or whatever chemistry, life science related things.
Mm-hmm.
Again, having access to a lab, having access to compute resources, having access to FDA specialists, there will be things that will be overlap between them. And I think instead of doing one
Because
at
you
a
batch
time,
work on some of these.
because the resources can be shared between the different
Yep.
groups that
Yep.
have exactly the same needs. Each
Right.
company doesn't need one FDA regulation specialist, right? You can have 10 of them
They can be on a
that you
retainer
have
for all of them.
and can support all of them, right? So, and the paperwork that goes into it, and the setting up the all of the testing that needs to be done.
Mm-hmm.
So, I think within particular specialties, you're probably right that you can do this, and you can do 5 companies, you can do 10 companies at a time. We're not there yet, so maybe that's the
Right.
path forward.
I'm saying this because Lian, who was, so she was the first she used to work at Valor Capital. I'm name dropping her because she's the first person who believed in our project in my first company,
Mhm.
put in some money, and recently joined 2 other GPs to co-found a fund called Marvelous VC. And they're not just deep tech, they call themselves Marvelous Ventures, Deep Tech, and Catalyst. So they have this vision.
Okay,
I had a call with them
catalytic,
yesterday, that's why I'm
yep,
saying this.
catalytic
So
capital.
catalytic
I've heard that
growth,
term.
where they already have the industry connections, they are within a certain sector, and they're going beyond just investment. I even had
Right.
hopefully she can come on the podcast a bit later. She's really flooded with a new fund. Another person from Regenerate Capital that should be on the show very soon. Same, it's an asset management company. They have a PE fund, but also a VC fund, and they're turning the
Mhm.
VC fund in kind of a invest in the companies that will benefit the PE and the asset management part. So it looks like it's a roll up. They're not exactly acquiring, but they have the same mentality of a CVC. So
Right.
it's all moving within a specific funnel. And this is why I'm saying that this hybrid is going from VC down, but it feels like those are fishes slowly growing small legs, whereas you created something that immediately has legs and cannot breathe in water. So you went
Right.
to the extreme opposite.
Yes.
Whereas it feels like the tendency in the industry is to come slowly from one end, and you thought, let's skip that. Let's just go all the way to the other end, and
Yes.
hopefully the adventure model grows enough to create a traction even more for that that transition from one to another. As an
Yeah.
operator, I dream of this. I would love one day to be part, and I think this is something that we're also developing with Pitch Deck Creator. We would love to have funding to put in some companies and keep doing the operational support. But as you said, it needs to be
Mhm.
focused, and there's many conditions to put behind this. DC, it's been already an hour for what was supposed to be a 20-minute
Yes.
segment, and it was
Yes.
fascinating. Actually, now I'm thinking of, instead of doing the last segment, how to build a unicorn, I'm thinking of how to build an amphibian, or let's find another creature. What was the name of the first fish that went from the ocean and started to walk?
Oh,
like an axolotl or
Sure.
something like this. I love those
Yeah.
animals. Fascinating. So let's move to section 2, which is
Okay.
the fast-paced yes, no, this or that. Let's start with the
Okay.
this or that, and then of course maybe some of these will have partly answered prior, so the discussion aspect will be a bit shorter, and some of it will be brand new, so we'll discuss it. Whenever
Okay.
you're ready, we'll go.
I'm ready.
Good to
Let's
go?
do it.
All right. I was gonna say, how do you say 3 to 1 in Japanese? And I was ichi san. No,
San,
ichi
ni, ichi.
san.
San,
Say it again, please.
san is 3.
San.
San,
Yeah.
ni,
Ni
ichi.
ichi. Well, san ni ichi. Do you prefer being a founder or an investor?
Both. That's why we're creating Unventures.
Angel or institutional?
Angel for sure.
Revenue backed or VC equity?
Yeah, well, that's easy, right? Yeah, revenue backed.
150 bets or 15 hard convictions?
Again, that's the idea with Unventures is going to be 4 hard convictions,
Right.
as
4.
opposed to a large number, or maybe 5 or 6. But yeah, very small number that we need to make sure we're going to get a return on. Not necessarily a big return, but a return.
A return. 8-slide teaser deck or 15-slide complete deck?
That's a good question. And I'm going to answer that one not from the Unventures, but from the Chemical Angels TCA, kind of accelerator point of view. An 8-slide teaser deck doesn't do anything for me. I need at least a 12-slide and not more than 20-slide pitch that tells me the story. And so on my website, pitchingangels.com, there's a subsection called pitch deck. And anyone who wants to know about that question should go specifically there. The first article on there is the 11 slides of the perfect pitch deck. And it's not just a list
It
of
will be
slides,
linked.
it's why you need those slides, and it's about the story, right? So what a lot of people miss by Series A, they've got it down, right? The pre-seed ones don't really get it. And they come in and they say, look at my
Gotcha.
wonderful product. Look how big the problem is. Look at my wonderful solution to it. And by the way, here's the competition because you told me I need a competition slide, and here's the team slide because I need a team slide. That's not what the pitch deck is about. So what's an investor want? I've done this before, right? An investor wants to make money, right? That's why we're investing. It doesn't matter whether they're an angel or VC or your uncle. Well,
They
your
want to
Uncle
make
Bob
money.
is different, but anyone who's investing to make money, that's the goal, is to make money. So when you're pitching, you are selling something. You are selling stock in your business. And you need to tell people why they're going to make money from that stock. Well, they're going to make money from that stock because there's going to be a giant exit. Who's going to acquire the company? What kind of companies do they acquire? Why would they acquire your business? Well, they're going to acquire your business because you're going to get to $100 million. So what's your revenue projection? How long is it going to take you to get to $100 million? How much capital is it going to take you to get to $100 million? Well, you're going to get to $100 million because there's a big market opportunity. So what is that big market opportunity? What's the TAM, SAM, SOM? So just because there's a big market opportunity doesn't mean it's an easy market to get to, right? Consumers, how are you going to get to consumer, right? Are you going to put ads in the Super Bowl or the World Cup? You better have, $1 billion to do that, or at least hundreds of millions. Or is there some easy way? Do you have some influencer? Is it going to be distribution? Is it going to be Amazon sales? How are you going to get to those customers without spending a lot of money getting to those customers? Right now, you have no competition, right? Because you're doing something new and unique. You get to $10 million in revenue, and there's going to be 100 people who say, that's a great idea. I can do that. I can do it better than you. How are you going to stop them? So your pitch is a story, and it's a story of how you are going to a real solution that's going to get you into the market. Here's how you're going to grow to $100 million, and then here is how you're going to be acquired, and here's the terms. I need to see the terms. Here's the terms I am asking for at this point, because at the end, you're selling me stock. So how much are you going to charge me for that stock? I need to know. So a teaser pitch that says, look at this great product we have, does nothing for me. I need that story of why this is a good investment before I want to spend any time looking at it any further.
A great pitch is essentially a set of slides that are like different flying papers, but it needs to feel like one. It needs to flow.
Oh, it's a flow.
It's all
Absolutely.
connected.
Yes.
It's a
Yes.
story. It's
That's
a
right.
paragraph.
It's a story of how you are going to get to $100 million, sell the business, and make me, Mr. Investor, a lot of money.
Thesis driven or opportunistic investment?
So for the venture side, for the angel investment, is is all about venture scale, right? It has to be thesis driven because that's the only way you're going to get to $1 billion exit. For unventures, it's opportunistic, right? I have something that people are willing to pay me for. I can build it. I can get it out in the market. It may not be a huge thing, but it is something people need and nobody else is making it. So we're going to take over a very niche market. Opportunistic, absolutely.
Solo founder or co-founders?
Again, for the venture side of things and for the angel investing side of things, really want to see co-founders. Especially, I'm used to looking at hard tech things. You need somebody with the technical chops
Complementary.
who's really knows how to build a technology product, but then we also need somebody who understands the business side of things, uh, who can run the business, who can do the sales, who can do the fundraising. So you really need co-founders. It's pretty rare you find one person who can do both of those, and it's time to do both of those because that's close to impossible. For unventures, kind of what we're doing is we are coming in as a co-founder. So if you don't have a co-founder,
It doesn't
that's
matter
fine,
because you're
right?
filling that. Gotcha.
Especially if you're the technical person, you've got a great invention. We are the business people, so we can come in and build the business side.
I like this one. What brings more joy, the first raise or the exit?
So as an investor, it's the exit, right? That's the only thing that matters is the exit, because until the exit, all we've done is put our name on
Pray.
a cap table. And yeah, taking out the money that would have gone into buying a new car or taking a trip or something like that and added our name to your cap table. So there's no joy until you get to the exit.
But as a founder,
I mean, as a founder, well, there's a lot of joy in that first sale, right? The first dollar, you frame that. There's a lot of joy in that first investment check. And the exit is usually surprisingly anticlimactic, right?
it's
You
more like a
probably
relief.
spent it's a relief. You've probably spent a year in a sale process. You've talked to so many different potential acquirers. You've gone through diligence that's taken 3 months or 6 months, and it's all about lawyers, lawyers, lawyers. And finally, you sign the thing, and some money goes into your checking account. And it's a life-changing amount of money that went into your checking account. But you're like, it just takes so long, and you kind
It
of
doesn't
know
hit the
it's going to
same as the first
happen,
dollar.
and it's yeah, we're the first dollar. It's just like, yeah, we're on our way now. This is great. So it's surprisingly anticlimactic and exhausting.
Right. Japan or Silicon Valley, where did you learn the most precious skills?
Japan, because Japan was just a different way of looking at how to build businesses and how to work, right? And how people work together. And I had worked at big companies in the US before going to Japan. And everyone was like, yeah, here's my responsibilities, here's how much I get paid, here's my hours. When it's 5 o'clock, I'm leaving, and anything that doesn't get done is the company's problem. And if you, my colleague, has a problem, that's your problem. Went to Japan and everything was collaborative. Even at
There's more
big companies,
dedication.
it was dedicate you, and everything was group responsibility. It wasn't individual responsibility.
Right.
And I found that that really translates to startups. I learned how to build a startup by working in Japan where they don't have startups. It's kind of strange. But the collaborative aspect of everything is group responsibility. You wear whatever hat is needed to get the job done. It doesn't matter what your responsibilities are. It doesn't matter what time the clock says. The customer is waiting. You solve the customer's problem. If the guy next to you is stuck, you don't leave because you have to help him, because that if he's stuck, the company is stuck and the customer is stuck, and then your company is dead. So everything's group responsibility. Everything is about making sure the customer is treated well and gets what they need. And that to me has been, I've brought that to all the startups I've built. And I think that is the key to success.
And the final question, would you rather kill the unicorn or build one?
Yeah, I'd much rather build a unicorn. Absolutely.
Right. So thank you. It's funny because this segment is actually evolving. In the first episode, I was trying to stick to the format and tell people you don't explain anything until the end. I think we already covered the discussion part, so we kind of did two
Yeah.
in one here, very optimal. And you explained all your answers. Now we have the yes or no segment. So, are you ready for the yes or no slow edition?
Is that the first question? Yes, I am.
Yes. And that was a quick one with no explanation. Beautiful. Next one. Have you ever funded a company purely based on the founder, ignoring pretty much everything else in the deck?
Yes, too often. And this happens when you are a mentor, right? And then as an investor, somebody sends you a pitch deck, you look at it, you do the diligence process, you're probably with other people, keeps you grounded, and you look at it as an investment. When you're a mentor, you build a personal relationship. And
Yeah.
sometimes I've looked at the companies, I said, this is not a good investment, but I really like the person. I want him to succeed. And so it becomes a friends and family investment, right? And I won't
Gotcha.
do a huge investment in that case, but I have done that multiple times.
But that would be more on the angel side. On the institutional side, this would be a lot less
Yeah,
happening.
institutional. So actually, something you'll see with the institutional ones, they will at times make, so the big VCs will, the GPs will at times make personal investments. They'll say, oh, this is too early for the fund, but I like what you're
But as
doing.
an angel, they'll do it
But as an
on the side.
angel, yeah, yeah.
Gotcha.
So
Okay.
if you look at Theranos, I don't know, we
Yeah.
could spend all day on this one, right? So I
Oof.
forget the original investment was by I'm blanking on his name, but it's one of the big VCs. I think it was I think it was Horowitz. I could be wrong.
Anderson? Yeah.
Um, but it wasn't Andreessen Horowitz that invested. It was Horowitz himself because he was friends with Elizabeth Holmes' parents. They were neighbors, and he was like, "Oh, she's a Stanford
Really?
student. This looks interesting. I can't get. I mean, there's no way we can get it through A16Z, but hey, here's 10K, right?
It was Tim Draper.
Draper, right? Okay, it was Draper, right? But it
That's a funny
wasn't
story.
a Draper investment. It was a Tim Draper investment
It was
as
a
a
Tim Draper.
personal
Right.
investment. Now, then she went off and told everyone else, Tim Draper invested. It's Draper Investments and everyone's like, oh, Draper invested. Well, we'll put in money. We don't need to do any diligence. But he did it as just like, oh, you're a neighbor, your friend. It sounds like, yeah, it sounds interesting. Here's 10K or whatever the number was, 100K. Um, so
Interesting.
they will
Okay.
do that too, but it needs to be a personal relationship, not just somebody sends you a pitch deck and you say, hey, would you
Right.
invest? And the answer, no, no, you got to go through our process.
Have you ever passed on a deal and immediately regretted it?
No, I've never, no, I take that back. I take that back. I did once regret passing on a deal. Just I was too busy. I was traveling. There was a deal I liked, but I didn't have enough time to look at it. And by the
Hmm.
time I did have time, the
It
round
was
was
close.
closed. Then a year later, they came back with the next round, and I invested in that. And a year after that, the company went out of business. So I lost it all.
It
So
is. It is what it is. Sometimes the
yeah,
destiny cooks for you.
yeah. Well, but I did invest, and I did lose my money. It just took longer.
It happens. It happens. You probably learned a lot from this. Do you think most pitch decks that you receive are bad?
Yes, especially I'm looking at pre-seed startups. By the time they're at Series A, they're usually really good. But the pre-seed ones, and especially I'm at an accelerator, so they haven't, I'm one of the first people looking at them. They are awful.
Hmm.
And a lot of what I do is that's why I have the website that says this is what you need to do in your pitch deck. This is what the pitch deck needs to be. This is what
Is
investors are
avoiding
looking for.
repeating yourself 50 times or 500 times. Put
It's
it there.
it's don't give me a slide that's full of 100 bullet points, right? It's,
Yeah.
um, don't try to answer every single question in the pitch deck. Don't spend 10 slides telling me about the problems of climate change. I know that, right? It's actually the other way around. It's rare to see a good one.
To the point that it makes a difference, like a massive
Yeah.
difference.
Well, yeah, it makes a difference. It tells me they know what they're doing.
Gotcha.
And if I see a bad pitch deck, I think, okay, they're amateurs. They don't know what they're doing.
Right. Is a cold outreach ever actually worth your time, or do you only work with warm introductions?
So I'm not a big fan of warm introductions. And I know that's the way the VCs work. The angel world works a little differently. That
Hmm.
you're going to have to go through. So in in venture, like a smallish fund, like $100 million fund is going to have 6 to 8 employees, right? And then probably 2 GPs that are decision makers. So it really is about personal outreach and warm introductions, and because they're going to get 1,000 applications and they're going to ignore most of those. The angel
It's
world
it's
is
easy
different. We
to
have
find them as well.
Yeah, yeah. The angel world, so a group like Chemical Angels, we have 75 members and we will evaluate the deals as a group. So not all 75 people are going to be involved in every deal, but there's a lot of expertise that's spread among the members, and we are all GPs, right? We are all making the decision. We have a fund, but it is us voting as a group on the investments. So you come to me and you say, "Hey, DC, are you interested in this deal?" I'll be like, "You have to go through the Chemical Angels application process, the same as TCA." So I can take a look at
Okay,
the deck and I can give you some feedback, but I'll get warm introductions saying, "Hey, TCA ought to look at this, or Chemical Angels ought to look at it." And I'll spend
gotcha.
like, maybe a minute. I'll look at it. I'll be like, "Okay, well, it kind of fits in with Chemical Angels. You need to fill out the application." And then the application will start the process, and you have to go through the process, and that's the only way. So warm
Right,
introductions with an angel group doesn't get you anything.
right. Have you ever invested in a good company, but the deck was terrible?
Yeah, especially you see that in hard tech. You'll see like really scientific founders that
Who
don't
don't
know how
know
to do a
how?
pitch deck, but they have
Gotcha.
something really exciting on the technology side, and we're like, yeah, this is so good. Your customers are probably like five big companies anyway, so it's not really about sales.
Okay,
So we'll look at it, we'll evaluate the technology.
gotcha.
We'll often recommend that they bring in like a head of marketing or somebody else, but and maybe even a CEO sometimes. But I have invested, again, I'm investing very early stage. They're going to need to fix that by the time they get to probably even seed stage,
Is the Silicon Valley ecosystem still the best place in the world to build a startup today?
without a doubt. Or at least to get the funding. Let me qualify it. To get the funding,
Okay.
yes. That's where your co-founders are going to be. That's where the excitement is. That's where kind of the whole ecosystem is. If you're doing hard tech, if you're doing chemistry, you don't need to be in Silicon Valley, right?
So
You need chemistry
software,
labs.
Silicon
But for
Valley, not
software,
necessarily
for
software.
AI,
Gotcha.
absolutely. That's where the world is. Now, your team may be spread
Right.
all over the world,
Mm-hmm.
but
The founder needs
your
to be there.
founders, your customers, they're all going to be in the Bay Area, and
Right.
that's where all the money is.
Maybe a bit more personal question. Would you do it all over again?
Yeah, absolutely. I've done well. I've enjoyed it. Why not?
Great. Now, my personal question is Joy Miyazaki, the character of your book, a reference to the filmmaker Hayao Miyazaki? Right. Is it a reference to anything else? Is it just a common name in Japan? You just decide to go with this?
So it's a Japanese American name. I have to go back and try to recall why I named. She's not the main character, so her name wasn't that important. And she has a Japanese name that's based on her birthday. But yeah, it was not named after the filmmaker, anime
Fair enough.
filmmaker Miyazaki.
And the final question, are you having a good time on the show?
Oh, this has been great. I love this.
Thank you so much. Right. So that's the end of our yes or no, this or that segment. You've actually made a great job at always explaining and giving context, which is the whole purpose of this, is getting a great straight to the point answer, yes, no, option A, option B. And then of course giving the context because context matters.
Great. Yep.
So thank you. Do you still have a little bit of time to do, say, chapter 1 of building the unicorn, maybe a few core principles, or do you have to run?
I can keep going. You
Um,
must be really tired.
I'm exhausted, very sweaty. The
Yes.
lighting is becoming really bad, but it's a great
Right.
conversation and I'm learning so much from the process. Right. So we're now moving to this part 3. Do you want to present very briefly your book, How to Kill a Unicorn, why it came to be killing the unicorn and not building it? And then we'll move to this imaginary section of building it. And you can even tease a little bit the sequel of building the unicorn.
Okay, so we'll start off. This is To Kill a Unicorn. It is a mystery novel. It's not actually about killing unicorns in general. It is about killing a specific unicorn that was doing very evil things. I started writing this about 10 years ago, and it was kind of based on Theranos, except it went way beyond Theranos. Theranos was fraudulent, but imagine the founder was willing to go one step further and actually kill people to build a successful business
Right.
because it was a trillion-dollar opportunity.
Because that's what Forbes under 30 all do. They all end
Yes,
up in jail, right?
yes. This was about how was a hacker who found out what was going on there because his friend
Okay.
was was missing. And how is he going to stop her? And he's going to stop her by destroying this business that was actually a pretty evil business. Um, but everybody thought it was great because they've invented teleportation. What could go wrong with that? So it's a
Nothing.
mystery novel. It's a farce. If you enjoyed the TV show Silicon Valley, it's kind of like that. It's written from the point of view of a hacker who works at a company that I would get in trouble for naming, but let's just say a large search engine company that also does mapping in Silicon Valley. And then his friend is missing, and his friend works at a startup that's developing teleportation. He needs to figure out what's going on. So he starts looking into it. And it's
Right.
designed to be a humorous, sarcastic, farcical mystery with lots of engineering humor set in Silicon Valley. So it's fiction. It's not really about killing unicorns. It's about solving this mystery. So that takes us to, but if you want to build a
Build a
unicorn,
unicorn.
that's actually what I'm trying to outline on my website, which is
Right.
thepitchingangels.com, which is what do you need to do, and kind of what are all the questions, what are all the problems, what are all the misunderstandings, kind of based on my own experience, both as a founder and as a mentor and as an investor.
Right. And this is a book you're currently writing, so putting in a book
Oh,
format everything that you've shared, maybe distilling the essence of that. Is it going to be in a novel as well?
no, no, no.
Creating a
Oh,
story out of
well,
it, or is it
so
going to be more
so
academic?
uh yeah, so on the website right now are something like 250 articles, and it kind of covers a very wide variety of things. Some of
Spectrum.
it
Right.
and some of it is a little bit like this is what's happening this year sort of thing. Uh, so I do want to distill that down into one book of here's what you as a founder need to know in order to build a venture backable business. And the title for that is going to be How to Build a Unicorn. So
Right.
whether that becomes something that's published by a big publisher or I self-publish it, I'll worry about that later. But that is kind of the idea of I'm going to take the website, which is just a whole bunch of separate articles, and distill that into a handbook, a guidebook.
Maybe because this is a project ongoing, I'm starting to think the whole part of the podcast where we actually try to build the intrigue around this might not be as relevant. Let's think about this as a project. Say this,
Yes,
you're building a product. How are
yes.
you going about it? Is it going to involve AI to do all the recollection of everything on your website? Are you just going to take that opportunity yourself to go back by hand, check everything? Maybe I'll also do some cleaning on the website, some articles you believe are not necessarily relevant, or you have a better version of it, you might rewrite it, etc. How are you tackling this daunting project? I mean, you are already very active on LinkedIn. So if you had to collect not just the website, but also everything that you're doing on LinkedIn, everything you're sharing, you'd have for 10 years to write this book. What is the kind of timeline you're setting yourself for? Is this supposed to be a one size fits all, or are you going to take a specific angle, a specific industry through which you're going to build this? What is the methodology? What is the resources you're allocating to this? Tell us more about this kind of project.
Yeah, you're asking a lot of questions
Sorry.
that I haven't answered yet, but I don't use AI for writing. And that's kind of in the writing world, that is
Sure.
considered like the worst thing you can do.
I was
Now, if
meaning
I
more
just
for
wanted
like
to put
collection and synthesis more than
I
writing.
mean, like everybody else, I'll use AI for background information for looking stuff up. I used to use
Gotcha.
Google, now I use ChatGPT. But for actual writing, no, that's all
Of course.
written and edited by me, which means it's a large project. Now, I have 250 articles. You would think distilling that down would be a week-long project, but I think it's like a 3 to 6 month project. It's going to be a lot of work. It's because I can't just take each of the articles and just string them together and make some changes if I want to make what is essentially a coherent handbook. So I can use that as the starting point, but then the whole thing needs to be rewritten. So it's a big project, which is why I haven't done it yet.
It sounds daunting. You say, oh, you might think it's a 1 week project. I had zero, there's not a single
Yeah,
world where I thought it was a 1 week. You're
yeah,
saying 3 to 6 months. With everything
yeah,
you're doing on the side, this is a very optimistic
yeah,
projection. I mean,
probably.
if it's just the collection, okay, maybe.
Yeah, it's rewriting everything and kind of putting the pieces together in different ways. But to give you an idea, like the second book, the first book was a little messy, but the second book, A Countdown to Decryption, it took me a year to write it. and a year to
Right.
edit it, and then a year to publish it.
Right.
So writing a
That
book
gives the
is
timeline.
essentially a 3-year project. The fact that I have the
Right.
articles already placed means that the 1 year, the 2 years of writing and editing, I think I can get down to about, 6
Yeah.
months.
The the ideation and content is effectively
It's
already
already
there.
there.
It's about
Yeah. And
putting it together.
nonfiction that way is a lot easier than fiction too.
And then, so that's probably one of the last questions. Why not going for a fiction? Why not turning this whole process into a story? Because I feel like your website already has a very, I want to say, borderline academic purpose of effectively teaching, and you're sharing your learnings as
Yes,
teaching.
that's what the website is. Yeah, it's
Putting
informational.
it putting it in a book format would be the perfect opportunity to turn this into a story that maybe allows to go through the same principles, but through a more relatable format. Maybe someone can identify as the founder if you're writing a novel, and in that way, they're learning alongside them. So they have
Right.
not a co-founder, but they follow the journey of the person and learn alongside, rather than an nth lecture, an nth article about how to make a company, or
Right.
an nth book how to write a company. How do you differentiate from those all of those books that I haven't read of how to build a startup?
Yes. Okay. So I did that. I wrote a book. Um, it was about a startup that had invented a better compression technology, and I finished writing it about 3 months before the TV show Silicon Valley came out. So this is a long time ago. And I was in the process of trying to find a publisher. There's no self-publishing in those days. So I was in the process of finding a publisher. And there were some publishers that were interested. They were like, well, we don't know anything about Silicon Valley. There's not much of a market for Silicon Valley. Nobody cares about tech. But, okay, maybe. And in the middle of that, the TV show Silicon Valley came out, and everyone's like, oh, well, you just copied Silicon Valley with your startup that is inventing a better compression technology, and that was kind of the end of it. So I could go back and rewrite the book. At this point, the whole world is so different; it'd be starting from scratch. But yeah, the idea of writing a novel from the point of view of a startup founder, there is a lot of drama in startups, right? There's a lot of drama in finding funding. There's a lot of crazy interactions. Yeah, I could do that. I would
For
just need
sure.
to come up with, well, what is the story? What are the characters? What is the conflict going to be? What's the resolution? How are they, what are they going to do? But in the meantime, I have this other story I really want to write, which is about is about a toaster that suddenly starts writing text on toast and
Mm.
then becomes a prophet that takes place in Silicon Valley, because basically the toaster is the voice of ChatGPT, or one of the other things. And the toaster then believes it's God, right? And people start to think he's God, or it's God. So this is a crazy story. I've written parts of it. I need to put together, but this is a story so it's not about venture capital, but it is about Silicon Valley and AI and kind of how the rest of the world interprets it.
Ever heard of the Netflix show Love, Death, Robots?
I've heard of it. I haven't seen it.
You need to watch the episode. Well, you can watch all of them. They're very short, like
There
10
is there a
minutes.
toaster? Is it about a toaster?
No, but it's called the yogurt. And the yogurt is like, I'll just pitch it without
Okay.
spoiling it. Scientists are making an experiment, and a
Hmm.
bit like the vaccine, the penicillin story,
Yeah.
someone drops a bacteria in there, like some mold, and the yogurt
Okay.
evolves and it becomes science. So it speaks, and the yogurt starts to speak and says it has a
Okay.
solution to solve the world economy.
Right.
And it turns out the yogurt
All
is
right.
actually
Somebody already wrote
pretty
my
good at
story.
it. And then and you'll see what happens. But you
Yeah.
should definitely watch it.
Okay.
And
There's
there's no
there's a
problem doing
novel.
something
There, there
that has been
there's actually a
done as well,
novel
because
written. There's a novel that takes place in Silicon Valley called Sourdough, which you talk about yogurt. Okay, so sourdough.
uh,
It's again,
yeah,
it's microbes that then become a mass and then kind of take over the world because they're actually smarter than humans. And that's a funny novel as well that I can recommend.
there's nothing wrong in writing something that has already happened, or in your case, you were writing something that was going to happen. There's this
Yes.
whole story of there was this book. I don't remember the name of the book, but before the Titanic, there was a book that came a couple of years before with the biggest sailboat
Yeah.
that was called the Titan instead of the Titanic. It had the exact
Right.
same features.
Right.
It had a collision with an iceberg, etc. Maybe you were just predicting
Maybe the
something
toaster is going to take over the world.
that toasters will take over the world. Well, on that note of toasters taking over the world and venture capital that don't do venture capital, I think this podcast is coming to a nice end, and I'm really glad we covered all of those topics. It's not necessarily exactly the pitch deck discussion that we would try to have, but I believe it brings something different, and there's always value in something that is different that you don't necessarily hear every day. So I was very happy to have this conversation, DC. Honestly,
These were great questions. I really
anytime.
enjoyed it.
Thank you so much. Thank you so much. And all of those conversations about Japan also makes me want to go back. I
Yeah, you got to go.
love that place. And yeah, definitely a lot of things to learn from the more super corporate and somehow VC lacking space that taught you so much about how to work in a company. Any last words? Any event you might attend? Any cool thing you want to share? Any last words?
No, I've got a couple of startup mentorship programs where we're going to have in-person intensives in May and June. So, and a
Okay,
lot of things we've talked about here are kind of things we talked about there. So it'd be nice to be able to pass that along to the group. But those are
right.
small. Those are like 15 companies. So I don't have anything else major planned other than I'm working on my edits to my third novel now, which takes place in Japan. Nothing to do with startups. This is about a sake tasting tour of Niigata, which is kind of the Napa Valley, not the Silicon Valley, but the Napa Valley of Japan,
Yeah.
with the best sake
Okay.
and the best food. And on the tour, after the first night of the welcome party where they eat blowfish, one of the people dies on the train on the way to the next stop. So the title is Murder on the Snow Country Express, and I'm working on edits to that now.
Does the sake start speaking at any point?
No, no, no. Well, I guess the people
Because
are drunk enough that they start hearing it.
I was going to say, but sake can make you speak. All right.
Yes.
Very nice. Well, then we'll be looking out for this new novel. And
Yep.
yeah, we'll put all the links, everything will be in the description. For the audience, thank you so much for sticking with us
Sounds
this
great.
entire time. Of course, this podcast will have, if you're watching the video version, you're on YouTube, there's a Spotify version if you need to listen this in a car. And we will also make a bunch of edits. So if you see clips, shorts, and reels on other of our media, that is also great. Share this with everyone. DC, it's
I will
been an
do that.
immense pleasure.
Yep.
Thank you so much.
Same here.
And looking forward to our next conversation.
Sounds good. All right.
Cheers.
Thank you.
Bye
Take
bye.
care.